Hey, good afternoon. Welcome back to Short Verticals. I'm Brett Crowther. Good to be with you another Thursday afternoon as we get out there and look at what's going on in the market and what opportunities we can take advantage of with short vertical trades. It's good to be back with you after I'll cover some of my adventures over the last week, and we got to talk about what happened in this market. We got to follow up on some of the trades that we placed last week, some of the paper trades, and then look for those new opportunities, see what we can place this week. And so stick with me as we go through it. Good to have everyone, Ricebird, Wacky Whack, Andrew, Richard Judge, and more. Good to have you aboard with me today. Lots of others. So before we get going though and get deep into it, I do want to cover a couple disclosures. So stick with me for here for about 10, 20 seconds. Do you remember the options do carry a high level of risk and are not suitable for all investors? The information here, it is for general informational purposes only. Should not be considered an individualized recommendation or investment advice. Paper money application is for educational purposes only. Short options can be assigned at any time. Keep that in mind, regardless of whether they're in or out of the money. Investing does involve risk, including loss of principal, and past performance is not a guarantee of future results. Also, here are your option Greek disclosures. Do note that if we use a stop loss, that is not guaranteed to execute at the price submitted. It can change from there. All right. Okay. Yeah, good. Hey, Speak Truth, good to have you aboard. So let's take a look at the market and let's just kind of recap. I mean, last week when we were talking about this, I was noting how the market really is dependent right now upon, at least a week ago, it was dependent upon what was going on geopolitically, right? Things were going well, then the market would respond well, and if it would not, then the market would take a dive, right? And so really it wasn't this typical, okay, looking at the technicals, kind of feeling it out, that type of thing. I mean, while the technicals still played a role, it really came down to kind of almost like the geopolitical aspect was almost like these major earnings announcements for the market, if you will. And we're still kind of in that spot, but just recently it's been a little bit better. Now we are actually adding to that by entering into earnings season. And so we got a lot of things that are going to impact our potential plays for short options. Because one of the things that we don't necessarily want in short options is a lot of volatility, just a lot of unknown. Volatility is fine as long as we can gauge that, right? Volatility helps increase those premiums so we can sell premiums a little bit higher. We get a little bit more income on those trades. However, it's the unknown. It's the earnings where the stock can just shoot one direction or another. That's really the challenge. And with the geopolitical issues and the earnings season just starting now, it makes it a little bit dicey on some of these plays. But we'll walk through just some of the ways we can deal with that and navigate these landmines in a way. All right. Okay, but looking at the overall market. So it dipped down through some level supports here. This is interesting because it did break through some fairly significant levels of support. I mean, it was in the channel. Let's kind of zoom in on this just a little bit here. Let's get right about there. We can see the channel that it's chopping around in, and then it broke down. And I noted that when it breaks a channel, it'll tend to run the distance of that. And so I'm going to duplicate this channel. I'm going to pull that down, and you can see it's somewhat close to that old support, depending on where we draw that. Maybe I didn't get the full range of the channel, which could have widened it a little bit more, but it's close to, that range. That's kind of the ballpark area of where that old support was. And so I was looking for that to potentially hold. It broke through that and dipped down, which opened the door for more downward action. But again, the geopolitical aspect was really driving a lot of this. When, some good news was interpreted, it, ran up. We had that massive gap about a week ago and up it went. Now what's happened is it's broken above. In fact, let's kind of extend that to the right. It's broken above the old highs. And so the SPX making some new highs, climbing up more and more and more. And so it's had a really strong run here. Now, this is going to be interesting. We don't know exactly where this is going to end. It's I'm going to watch for that. And when it does have a pullback, when the climb does soften and it rolls over and starts to pull back a bit, I'm going to look to draw a Fibonacci from here to wherever that is. Now, I can't necessarily do that right now because this may not be the top where we can anchor it, right? Let me activate this again. I mean, if it climbs higher, then I have to raise that up. And so it just depends on wherever that ends up, that top part. We'll look to add a Fibonacci, see where the retracement potentially could be for some pullback, and see if those Fibonacci levels happen to coincide with some of the other pre-existing support and resistance levels. And so that's what I'll be looking for between now and next week. But right now, the market's still holding up there. A little bit of a spinning top today. Is this going to end up being a evening star? And if you're not familiar with evening stars, I did a YouTube short. So please go out to our YouTube channel. In fact, let me find this for you. Let me pull this over. Go out to our YouTube channel, and on our YouTube channel, we have shorts right here. So it's just on this, landing page. There's shorts. And if you go there, these are really quick snippets. They have to be less than 3 minutes. So usually about 2 to 3 minutes, usually about 2.5 minutes, generally speaking. And in there, I did cover. Hasn't been too long. Here we go. Properly applying a morning star, properly applying an evening star. There we go. So that's the one I'm talking about. Is this one right here? Will give you an idea of what an evening star is like. And so these are pretty good series. I'm actually putting together a series on textbook versus reality because there's all these things we learn that say, okay, here's what a dark cloud cover, piercing lines, through-eye soldiers, haramis, all these different formations. I want to do it on price patterns as well. What is a textbook versus what do we tend to see in the market? How does it tend to really play out? Because it's not always picture perfect. You don't often find them just like it was written up in the book, right? And so I do some explanations. I give some compare and contrast of what the textbook says versus what we tend to see more frequently in the market. So give those a look. And then, while you're here, do like and subscribe, please. It helps us a lot. It helps tell uh, tell everyone that these are valuable, you enjoy these webcasts, and so it just goes a long way. So please do like and subscribe. If you're already subscribed, do not hit the subscribe button because it'll unsubscribe you. So don't do that. But if you have not yet, please do like and subscribe. All right, back to this though. One more thing I want to bring up with the this overall move here. It's been interesting. As you can see, I put a resistance line on the RSI. And so this is showing that overall momentum was decreasing. And look at how that just totally broke through. This was interesting as it broke through that resistance line back here. And I was waiting to see if this would go up and kind of get stuck. Like that was the energy it needed to get up here, but then it'd fall back down and then maybe this would come down and bounce off of it, but it didn't. It just continued to go higher. And at times 50% can be a resistance level on the RSI, and it broke right through that. In fact, I'll show you one here in just a second where that was a pretty good example of the 50% being a resistance spot. But up and up it went. So that was our first indication. There was a lot more energy in this than just what we were seeing. Even though we had some big candles, there's a lot more oomph behind it. In fact, let me pull up Tesla and show you what I mean by having that RSI be resistance. Look at this. So this was Tesla. Tesla, let's move into this area over in here. Tesla is dropping down. You can see this diagonal trend line that it was bouncing off of as resistance. And then yesterday it popped up pretty hard and broke through that diagonal line and it broke through this horizontal support resistance level as well. But if we look down here, look at that. Look at how it had been acting as resistance for quite a while, just telling us that, yeah, it's having a hard time kind of moving over into the more bullish territory, right? And then finally, this is the one that broke through it. So this is interesting. Tesla possibly making a change. It's broken above two solid resistance levels, the trend line and the horizontal line, and bullish momentum is coming back into it, right? It finally broke through its resistance. And so with the price above resistance and bullish momentum coming back in, that could open the door for Tesla to continue to rally, maybe make it up to some old resistance like the 469 level. We'll have to keep an eye on that. Not so worried about the moving average right here. It's a 50-period moving average. But if we look at this, notice how it really doesn't obey it as a support resistance. Below it, maybe a little bit of touch here, but above it, below it, doesn't reach it there. No reach, no reach, no reach. It really isn't touching it. So while it's at that spot, not a real strong level. So not too worried about that. But that's a good example of it covering that. And the reason I knew that is because I did a hit on on the Schwab network, which is a separate but affiliated company. In fact, I posted that. Let me actually show you this. I posted that on my X account. I'll bring this up. So here's my X account. And do follow me on X. Go out to X, Brett Crowther, CS, and also Connie Hill, which I need to mention. Connie Hill is our chatter today. And thank you, Connie, for being out there. And by the way, there's a survey, it looks like, as well. So please take a moment, fill out the survey. I do read every single one of those comments. But yeah, Connie taking care of the chat. But here's where I talked about Tesla this morning. Made a note about the home sales. And then last week I told you I was heading off into Yellowstone real quick. Check this out. So went to Yellowstone with about 10, 8, 9 other people. Rode our bikes from West Yellowstone up to Gardner, Montana, about 55 miles. There's me and my wife, and got some nice photos along the way. And it's really great. There's a 2 week window for any of you who are cyclists. There's a 2 week window where they open up the road. Here's one of my buddies cycling down here. Open up the road for cyclists before they get it going for cars. And so it's a really good opportunity to get out there and experience the beauty of nature without having to deal with the car running you down. All right. So so please do follow us. Connie Hale at CS is her handle. And again, Brett Crowther, CS is mine. Now, I want to go back and review, yeah, survey time. I want to go back and review some of the trades that we have going on. So one of the ones we had last time was Merck. Now, this is interesting. As we look at Merck, this one should, be bouncing higher. It's not. Now, here's a question. We have it kind of dipping down. It's not doing exactly what we want, but there is still time. This is the question. Do we look to exit this trade? Or do we, look to see if it could make a rally and come back in? Well, yesterday we were within the box that we needed to be, and it isn't much further outside that. And the question is, well, how long do we have? Well, let's do this. Let's grab the drawing line here, and I can actually click on this and pull this over. We have until about there. That's 11, 14 days. So we have about 2 weeks, roughly 2 weeks before we have to be worried about that earnings announcement, in which we want to get out before that. And so there's still, the question is, in 2 weeks, could it possibly come back inside this range? Well, since it was there yesterday, obviously the question is yes. Now, if we didn't feel that it could bounce and move back up, we may look to exit that position. But, looking at the circumstances here, it is a little bit down, but it could rally back up. I'm going to show you another one where it did rally back up, and these are time trades. And one of the things about time trades is we need to learn to sit on our hands, be a little patient, be a little bit slower to respond than we might be in either a stock or a long call or long put type trade. And so we're going to let that one sit and kind of work itself out. Now, another one that was different, however, is APH. We got in this one last week, and this is a bear call spread. And so we're looking for this one to dip down. And so it bounced down, but gosh, we're looking for it to bounce off the resistance here. It hadn't. And it jumped back up and just continued to rally and run, 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 run. And so this one, you can see, even though there might be some time, it really just is not doing what we expect it to do. And so I mentioned last week, as it broke above, I said, hey, if this continues to make a move, I think it was like this day or something. Let's see, it would have been about right there last week. So if this continues up a little bit, I'm just going to go ahead and take the trade off. And I think a day or two later, I did, in fact, remove that trade. Just because this is one we look at this and say, you know what? Yeah, I may make it back, but we wanted to be back or out of it before this earnings announcement. So we don't really have the privilege of going all the way to expiration here. And so really this is kind of our timeline in here. And so if we look at it under that circumstance, we don't have as much time for it to make its pull back down into that area. So at that point, I said, okay, let's go ahead and look to exit that trade. And the last one that I want to follow up with that we did last week, before we get into looking in the charts and placing some trades this week, was CRM. Now, if you weren't here last week or unfamiliar with what we did on this one, let me give a quick review. Let me zoom in on this so we can really get the picture here. Is what we did on this one is I talked about doing a bull put spread. And so we sold down here. We did a bullish trade. Now the price was right here, kind of in the middle of this channel. And so with the price at the middle, we did a bull put spread. We wanted price to be above about this level, 175. So we did a 175, 170 put spread. So we wanted to stay above this level. But we also did a short call spread where we did a 200, 205. And so we needed to be below about this area. And so we had two trades on there, one a bearish one a bullish one. And those two combined created an Iron Condor. And I just wanted to demonstrate that time. If you want to go back and watch last week's session, you can see it. But I wanted to demonstrate how an Iron Condor really is not that difficult. It's stuff that you're already doing if you're doing these types of paper trades in this class. So what happened is between the two trades, we got into a contract. We got paid $1.92 We got on in a one contract. We got paid $1.92 for both positions. And what it allowed us to do is go a little further out so we weren't so close to the price action, which gave it a little bit more flexibility, a little bit more room to breathe. Well, but then just a few days later, it fell hard and it fell even more. It broke that level of support. Now, this is the management part that's very important to understand. And so what we did is I don't think it was in the class or wasn't in the class. Maybe we did in the class. We looked at that and it was 4 cents on those calls, meaning that call spread that we did that was up here, it had dropped so far that those calls were worth almost nothing. And so there's almost no value. So closed out that side for 4 cents. So of that $1.92, we took 4 cents and bought that back. So now we still have this profit potential of $1.88 on the contract, right? And then gave it some time. And this is a question that was down here. Could it come back? And yes, it did. And this is what I'm talking about. Sometimes we just got to look at this and ask ourselves, is it reasonable for this stock to come back, or is it just running away and not going to come back? Being slow to respond. And so far, you can see this one has come back. It's back up into this zone. And so we're actually at a spot where when I was looking at it earlier, I think it was like $1.30 or something. We could close that out and possibly walk away with, 80, let's see, $1.80. What is that? 50 cents or $50 on that trade on that one contract right now. But with it being up in here, and we still have some time, I'm going to let this one ride just a little bit longer, see if we can't squeeze a little bit more of the value out of that trade. But this is just a good example of not only setting up trades, but managing trades and, working both sides of that. And so hopefully that gives you an idea on just managing like those iron condors. Okay. Just want to check, see if there's any questions. I don't see anything. Oh, thank you, Jonathan. Missed that one about the beautiful spot. Yeah, in Yellowstone there. It was fun. It was fun. Except for on day two, we went to well, Mammoth and the Gardner. We stayed the night, but then the next morning we had to get up and it was like 40 degrees, 38 degrees. It's kind of chilly. And but it starts with a 2,500-foot climb over 10 miles. And so you get warm. It warms you up pretty quick. Okay, it doesn't look like I'm missing any of the questions that are out there. So, all right. So here's the thing. I went through and I was going through the list that I have. Now, there's nothing really special about this watch list that I have over here. I mean, really the watch list is just a real simple scan. Basically it's this, in fact, it's already there right there. Basically went out and I said, okay, let's look at the stock. And I wanted to get something like the last price. I was just looking for something to say I need a minimum price in there, and I put $70 on that for the scan. And the reason I wanted something like $70, because if you start getting really low, like 40 or 30 or 20 or something like that, then even if it has options, it tends to not have enough movement or value to make it really worth it for the spreads. And so maybe about 50 is where I start. And then if I get too many results, I'll start bumping that up to 70 or 80, just depending on what the results are. But so want a price that's at least $70 and then the volume. So I just came into this one and hit volume right there. And I put, I usually can start off with like 2 million. It's kind of my baseline. So did I get enough zeros in there? One, I think 1, 2, 3. Did I get them all? 1, 2, 3, 4, 5, 6. Yeah, 2 million. So we get 2 million on there, and we'll scan that and see, what we got. We have 136 stocks, and so still quite a few. And so here's where we can start playing with it and say, okay, well, give me 3 million. Do we have enough there? Looks like it. And we have 93. And so what will happen is you're going to start to recognize some of these symbols. And why? Well, it's because we're starting to weed out a lot of the stocks that have lower volume. And generally speaking, stocks that have solid volume tend to have tighter bid-ask spreads. And so that's where I started looking for potential paper trade opportunities. And then from here, you can just go ahead and throw these into a watch list, just save as a watch list right there just by clicking on the pancakes. Some people call that the 3 lines, whatever you want to call it, but you can just save that as a watch list. They'll throw it in to a watch list, and then we can pull it up over here. We can go to watch list, and then it'll go into the personal, and that's where I got this one, right? This is our class here. I showed this another time, but this is where I have this one, and so then I have the stocks. Now what I like to do is simply take those stocks, change the link till it's red, go over to a chart and change that to red, and then go through it. Just kind of walk through it and say, okay, well, what's the first one like? Is there anything there? Nope. Next one, anything there? And I can quickly scroll through the chart and just kind of visually look and see, is there anything potentially setting up? What are the opportunities looking like? And it's a quick way to go through and just analyze the stocks. And then if there's something that is setting up a little bit more, then do a little deeper dive. And in fact, as I was going through one, I noticed this one right here. So we have JP Morgan. Let's get rid of these channels that I have in here. JP Morgan made a little bit of pop the other day. It was actually before the earnings. That's interesting. But it made a little bit of a pop. And it's kind of sitting out here holding on. So let's draw a support level right here. Now it's after earnings. So the earnings came out, what was that, the 14th, so 2 days ago. Looks like it came in at 5.94, so it beat the estimate. And it didn't really climb, even though it had a beat, didn't really climb. It kind of chopped around, same spot. So maybe the guidance wasn't what people were excited about. But still, it's been holding this level. So this presents a possible opportunity to get into a bullish play. And so should we go take a look at this one? I think there was something interesting I want to show you about this. As I was kind of playing around with some numbers, just checking it out. So if I go to Trade tab, and by the way, you can also link this. And if you click on that and make that one red, then it's already populating with JP Morgan. And so it's like everything's kind of linked together and set up. And that's the way I like it. So I don't have to keep typing the symbol in every time. But looking at this, we have some opportunities here. Now, typically speaking, go out to look to about 20 to 40 days, so 30, 40 days, somewhere in there. And I thought this was interesting because I was actually looking at, I think it was I was up closer to 40, looking at the May 22s, and looking for around a 30 to 40 delta. And so I was looking at the 300. Now let's see how close this is now, because this is something that was interesting earlier, but I don't know if it's still holding up. So if we sell the 300, it's going to be a little bit below where we need to be, right? Because we're about 305. And so we could potentially sell something at 305 if we're looking to be a little bit more aggressive with that and thinking we want to play right at that support, but 300 gives us a little bit of a breathing room, even gives us some horizontal supports a little bit lower that come in. And so if we sell the 300, then we just need to be above that price at expiration. And then I'm going to hold down the control button. I'm going to buy the 295. Let's see what it's giving us. Oh, it's a little bit less than it was earlier, but that's okay. We're about 137. Now 137, and this is 36 days till expiration. All right. These are really wide bid spreads. It's widened out. But let me just see. Hang tight. Now, this is what I want to show you something here. But let's go to May 15th. All right. So I'm going to delete these. And let's try the same thing here. Now, you'll notice here, and this is something else I wanted to get to on this, Sandy, is notice these bid-ask spreads. Notice how they're a lot tighter. But I want to try this 300. I'm going to hold that down and click on the ask of the 295. And it shifted more. I think that bid-ask spread widened out. Now, here's the deal. When I was doing it earlier today, there was about 4 cents difference between the May with 29 days, the May 15th was 29 days, and the May 22 with 36 days. And so with that, it's a minimal difference. It's like, why wouldn't we go for a shorter time frame? In fact, let's just check the May 8th and just see what that offers us. See if we can get a little bit tighter even still, or have a similar credit with less time. So we're at 121 here. And so we're going from 137 down to 121 over the course of about what is that, 2 weeks, right? And it's also interesting to know as we were going out there further, there wasn't as much the activity, the volume. I didn't look at the volume on it, but there's just the bid-ask spread was quite wide on some of these longer dated options. And so it's always important to check. And if you see sometimes some strikes that just seem wide, check another month. And generally speaking, as you get closer to expiration, they will generally, until you get real close, they will tend to tighten up because there's more activity. Like the further out you go, the less activity there tends to be, right? Like something that has 3 weeks or 4 weeks to expiration tends to have more activity than something that has a year till expiration, right? And so with that, they tend to have tighter bid-ask spreads. And so it's always valuable just to kind of check those months and see if they're okay. So with this said, let's just see what we got here. Okay, $1.21 on, we're looking at the 8th, right? Yeah, May 8th, $1.21. Well, what's our setup here? Well, we have a $5 wide spread. We're selling the 300. So we're putting ourselves on the line to buy, we're putting a contract out there. We're going to buy the stock from someone else at 300. That's what we're entering into, right? And we're receiving a credit for that. But then we're using some of that credit. We're using some of that. Let's close this up so we don't get them mixed up. So we're selling for 365, but we're using some of that 365 to buy the 295 put, and that'll give us a right to sell it to someone else at 295, which then makes our loss $5. Now, the end result with that is, oh, it's moving quick. Let's see if we can kind of lock it in. At $1.20, that would be the profit we'd keep. And so $5 of risk minus the $1.20 potential reward that we get on that would leave us with an actual risk of about 380. All right. And looking at a return on risk, $1.20 divided by 380. So there's our max gain divided by the risk on the trade is about 31, 32%. Now, I've mentioned before that sometimes it's nice to see those kind of jive with the deltas. And this was actually not too bad when we have a 31% return on risk with a delta. Oh no, a 30 delta. I was going to say that's pretty low. This is pretty close. So it's pretty. You see a 30 delta and a 31% return on risk. We're kind of getting apples to apples here. What we want to be careful of is we start to see a real strong variation of that, meaning that our return on risk, let's say, comes in at or a return on that is like 10, 20%, and our delta is like a 40%. And so you start to say the probability of this not working out is climbing and the return that we're getting is dropping. We really want to see those come closer together. And right here, they're about the same. So let's go ahead and send off this trade. Let's create this trade. And what do we say? The risk was 380, right? We've been using $1,000 worth of risk in this account. And so if we divide that by $3.80, is going to be, that's going to be 2, isn't it? Yeah, 2.64. So we're going to round down. I can do 2 contracts. And so let's come over here. We're going to hit 2 contracts. We're going to see if we can get filled at $1.20. Now I'm on paper money, and so this is a little bit more likely just to get filled in real funds. And so I get the question from time to time is, well, that wouldn't, I'm not getting enough credit. Like if I only got $1, it may not be worth it. It may not be. But one thing we can do is we can set it at what we're good with, meaning maybe I don't want $1.20. Maybe I want, $1.25 or something. And I think that's the minimum I'm going to take, and I say, I mean, we as a group, we'd take for this trade in order to make it worth it. And you know what? We can send that off. And if it gets filled, great. If not, then it didn't give us enough premium. Now the $1.20 is fine on this, but I just want to say you don't have to necessarily take what's there. If the numbers aren't working out, send a number that does work out. If you get filled, hey, it's kind of like name your price. If it works for us, then they take it. Great. If not, then we didn't miss anything because it wasn't there anyway, right? Let's hit the confirm and send. So looking for any notices, any red notes, no, nothing there. And so looking with those 2 contracts, we make up to 240. That's $1.20 credit times the 2 contracts, and the risk of the 380 times the 2 is 760. And so there's our credit, there's our risk, and we're going to go ahead and send that off. And being paper money, it should probably fail pretty quick. It's a little bit generous on that. Okay, now let's go out and draw a box on this one. So we're looking at this going out the 8th of May, and we need to be above 300. So let's go over to chart. Now let's move over here so we can get out. We have room. Yeah, we do. So let's grab our box tool, and we're taking it from here today. We want to be above 300, so we're going to come down here, pull that out to the 8th of May, which is right about there. And this is our box, meaning we want it to be above the spot by the time we get to expiration here. That is the trade we're looking at. I always like to draw those boxes in there just to remind me. And another thing that's always nice to do, you don't always have to do this, but I like to say something like, sold 2 contracts, $1.20 I like to put, $1.20 each. Um, and then say like what was it? The 300 slash 295, 295. I get the five, right? Okay. We can see, I should put in our put. So there we go. And whatever makes sense to you, right? That tells me what I need to know. Sold two put contracts, got $1.20 per contract, 300, 295 are the strikes that we used. So that gives me what I need to know. But again, you can change that to whatever works best for you and just maybe put that in there or something. So there's our trade. Now it's just a matter of monitoring that and kind of watching it like we did the others, right? And that was nice because this one, already done with earnings, which is kind of a little bit rare. And so as I was going through it earlier today, I was looking at a lot of them going earnings, 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 right? That was kind of the theme of the day. But there are some things that we can do. There's sometimes we can play something even with earnings coming out. And let me show you as I was going through them. Here's one I wanted to give an example on. So this one is a potential bounce. There's either this one or was it OXY? Let's try this one. Yeah, let's do this one. Okay, so we can see Oxy coming back down, looking like it's going to bounce off this support level here. I mean, it's already starting to make a move off of that moving average. Just curious. I just want to see where we are with the fibs. And we draw our fibs from here to here. We're right in that ballpark where it should be, it's pulled back about a third. So a third to a half is kind of the prime spot. It's starting to get a little bit weak if it gets down here. And obviously if it breaks through the 62%, then it should see a full retracement. But this is kind of the sweet spot where we'd like to see a bounce. And so with a potential bounce here, we could possibly play this more almost as a directional play. Let me explain how that can be done even though we're doing it with short verticals. And so with this, we can get that out of there. Let's see. Let's see if we can get this out of this. So we're gonna go over to the trade tab and let's go to let's try when is that earnings? That's a let's call we don't have earnings. Oh, yeah, 5 5. Let's call sort of early May, 5 5. Let's come over to the trade tab and let's just see what we have here. So this is kind of early May. We want to be out well, there's May 1. Let's go with May 1 and just see if we can make something happen with this. And so looking at this, and sometimes we just got to play it. Sometimes you just got to go out there and kind of punch some numbers. Now, here's what I want to say as far as making this more directional. Typically, we're going into that, 30, 40 delta. This gives us a 41 delta, sort of the top end of that. 57 is even a little bit in the money. And so if we expected a bounce, we could even sell a 57. And let's just see what it does when we do a 57, 55. See, so here we have an 83-cent credit. All right. Now, that's a 50 delta. Here's what I'm saying. It's going to start to diverge a little bit. I'm not liking the numbers as they're kind of working out. Let me explain this. So if we're looking at an 83-cent credit and we have what, a two wide spread, right? We have 57.50. So our risk is $2 minus the 83 cents, right? So $2 minus that 83-cent credit that we receive is going to give us a risk of about $1.17, right? No, actually, it's better than I thought. 83 credit divided by the $1.17, it's going to be higher than I thought. Okay, it's 71% return on risk. So maybe we might be okay on this. But so here's the deal. We're actually getting a little bit more directional on this because if we go with that 57, we're actually selling some intrinsic value. And the whole idea behind this is to beef up. We know we're taking away some of the probability, right? We're going to 50-50 here, but we're beefing that up. Now here's the kind of the scary thing on this one. Is it's not quite high enough to really make me feel comfortable in the sense that if it's a 50-50 according to the delta, which is a guesstimate of what, approximation of being in the money. But we're a little bit low on that premium. I'd like to see it closer to 95, 100, even sometimes 105 if we got really lucky. Get a little bit more out of that. Now, one thing we could also do is check it with the 56 and just see, and sometimes we have to play around with this Say, okay, are we getting that? Oh, that's not even going the direction. So that one has kind of dissipated since I looked at it earlier. Let's go back and look at the other one, CVX, and see if we can make something work with that. Because this is a very similar situation, right? We can see it rallied up, coming down, potentially bouncing. Let's see if we have, yeah, we're similar in a similar fashion, right near a Fibonacci level, right? Do we have, well, we do have some support. It's not real super strong. We have some old resistance right in here, some choppiness right around this area. You can see all the times it ran up and then it chop, 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 broke above, bounced up, broke, went up, bounced up. And so it's right back at a support level. And we're about 185-ish, right? And I don't know if something's happened. I apologize if I'm not seeing any of your comments, but it seems like my chat kind of froze a little bit ago. Um, and so I'm sorry if I'm missing something, but I'm not seeing anything beyond about 12:11 my time. So about, what is that? About 20 minutes ago was the last time I saw chat come through. And I know there's been more than that. It just looks stuck. So just FYI. But anyhow, so here's what's happening here is it looks like it's bouncing off this. We do have this earnings coming up. And so when are we looking at this earnings? Well, the earnings is on, what are we looking at? May 1st. Okay. So not very far, but again, could we possibly place a little bit more in a directional play? Possibly, possibly. So we have CBX up here. Same thing, we're looking at that very short time frame, just 2 weeks out, right? And we're looking to be a little bit more aggressive on this one. What was the price again? The price we were looking at was around 185 and a half, 185, 186, right? Is where that support was. And so maybe let's see if we can get a little bit more aggressive here with the 187.50. Well, let's try 185 and then a 182.50 and see what that does for us. So we're building that one up a little bit, give us a little bit more breathing room on that. So let's just round that out. 90 cents. Let's say we get a 90-cent credit. Now this one is a 2.5 wide strike. 185. We're selling the 185, putting us on the line to buy the stock at 185, but we can then sell it to someone else at 182.50. And so there's a $2.5 risk. So we take that whoops, let's get the 250 in there. $2.50 risk minus the 90-cent credit that we'd receive on this. That gives us about $1.60 risk on that trade. And 90 cents divided by $1.60, we're going to get a little bit over 50% return on risk, or 56%. And so here's one where, 90 cents, yeah, we are risking, was that $1.60, right? But we did go a little bit lower, looking at that 39 delta versus that 48, which is a little bit more aggressive. And so this is more of almost a directional trade. And so we're getting a little bit more credit. We're putting a little bit more on the line, but we're okay with that in the sense that we understand we're looking for a pop. This thing should pop and run up or not. And it's just another way to modify those short verticals to, one, deal with the tight windows that we have in earnings season, number one, or two, playing some sort of technical pattern saying, okay, this is where it really should bounce and move up. And it gives us a little bit of cushion, a little bit more so than maybe a long call, because there's a little bit of time in there, even though it's not a lot. But it's still kind of blending this world of short verticals and maybe a long call play. So let's go ahead and run with this one. We got, what did I say, $1.60 was our risk. Overall, our account has $1,000 worth of risk divided by that $1.60. That should give us about six contracts. And so we'll go down, move this down to 6 contracts. We'll sell 6 of these contracts at 90 cents. Go ahead and hit confirm and send and look that over again. No, warnings or anything. And so $540 potential max gain, 960 potential max loss. Let's go ahead and send this one off. And again, what was it? 182.50, 185, 182.50. All right. And go back to our chart. And let's draw a box on this one as well, just to help us keep track of it. So this is the day we're getting in. We want to be out of it by May 1st. Where's our first, about there-ish, right? Okay, and that's the earnings announcement, so perfect. Look to get out of it by then, and I'm gonna move that up a little bit right in there. So this is, as you can see, this now becomes more of a technical play. We're looking for a quick bounce to head up, and if we get up somewhere in this ballpark, and then let that, we'll take some profit. And by the way, we're not looking for this one to melt away and take like, get it down to a very small amount, like, 10, 15%, 20% of the value left. And the reason why is because this is a challenge with earnings. It does give us an opportunity. Again, we're kind of mixing this, let's do the long call versus a short vertical. We're gaining some of the benefit of having some time decay work a little bit in our favor, but it's not going to decrease because of the implied volatility. And just before we wrap up, let me just throw on the implied volatility on this. Let's see, implied volatility, add that. Because what's likely to happen is we get closer to that earnings. Now this one isn't totally running up, and sometimes these already run up and they already, have their full amount. But possibly watch for this to gain a little bit more value. So it's going to help hold those values up a little bit. We're not going to see that total compression of the values if that implied volatility is at least maintaining itself or possibly climbing. Okay. So that's what I wanted to cover today. Hopefully a lot of good information in there as we, looked at the market, talked about some technicals on that, looked at the existing trades, talked about the management on that, and then threw on a couple more paper trades that we'll continue to monitor, manage, and discuss and learn from as we move forward with this series. So again, I apologize. Something happened to the chat. It's frozen. I'd love to see what you're saying, but I don't know why I can't, but it's just not there. So I'll let you go, but thank you so much for joining me. Again, fill out that survey if you could. We sure would appreciate any comments that you have. Again, do take time to read them all. And in fact, I'll look it up tomorrow morning. So, hey, have a great week, and I'll look forward to catching you next week at this time. All right, take care.